So if you're looking to understand the world, the news, and the markets, you come to the right place. Hey everyone, this is Chris, and this is your daily Uncut news. So I want to start with this. This is the four seasons. You guys know the four seasons, of course. And I want to ask you a question. Out of these four seasons, which is most likely to have the hottest day of the year out of these four seasons? And also, too, out of these four seasons, which season will most likely have the coldest day of the year? And knowing from experience, you guys probably already know the answer, right? So, out of these four seasons, the hottest day is most likely going to be in summer, and out of these four seasons, the coldest day is most likely to be in winter, right? And why are we talking about this? Well, I think this is a great relationship to the market and the world in general, is because I can't tell you exactly which day it's going to be, and I can't tell you what's going to happen tomorrow, but knowing sort of how the world works is kind of like knowing the seasons, right? You have a general sense of like, okay, I'm pretty sure it's going to be hot in summer, and I'm pretty sure it's going to be cold in winter. And if it's not, boy, we got a real problem, right? And it's interesting too, because if you start to get really good at this stuff, you'll get an even better way to sort of hone down your thinking of the world. So here's another example. Say talking about into next year, looking at this chart, and this is a temperature chart in New York City. So where you live may be a bit different, but the question would be, okay, so if I asked you which is going to be the hottest day of the year next year, which one, when is that going to be? Or if I asked you, okay, which is going to be the coldest day next year, when is that going to be? And you guys can look at this chart and you can actually kind of identify what it did this past year. And it's actually really interesting because literally it's right here. You can see here the warmest day was on July 21st. It was 85 degrees. And then the coldest day and the coldest that it got was on January 29th. And it was 28 degrees, right? And so the question I'd pose to you is, going into next year, do you expect July 21st to be the hottest day of the year? And going into next year, do you expect January 29th to be the coldest day of the year? And your answers, I'd be curious what your guys' thoughts on that, but I think your answer is probably going to be, well, I don't know if it's going to be July 21st next year, but you have a general sense that it's going to be close, right? It's going to be maybe around. There's a good chance of that, right? Because it happened last year. And you'd look at data over the last 10 years and say, okay, is it usually that week is the hottest? Here's another example. So even though, and this is why I want you to think about data, this is learning how to read data. Even though we know that the coldest day of the year, say, was January 29th, does that necessarily mean you're going to have the most snow that day on the coldest day of the year? Well, not necessarily, right? So, in fact, it was January 25th. They had the most snow in New York City. So they were close to each other, right? So 29th, you had the coldest day. 25th, you had the most snow. And this is another example to think about the markets. Like sometimes the days don't perfectly align, right? Sometimes the most snow, the coldest day is not necessarily the same day, but it looks like it's pretty much the same week. Like you're in the same ballpark. And this is sort of how you want you to think about data. You may not be able to get it exactly right every single day in the market. You might be able to find the exact top, the exact bottom, but you can be close if you kind of know what to look for and you know what you're doing. Here's another way to think about it. And this is always fun to talk about the weather because it's actually really crazy. If you look at the data, you can figure stuff out. So take a look at this. It turns out, if I'm looking at this chart, and this is how you read charts correctly, I'm thinking 4 p.m. is kind of when it gets really hot. You can see it right there, right? And I'm thinking around maybe, I don't know, maybe 6 a.m. is when it's most likely cold. And actually, they're saying very cold and freezing. Yeah, so you could argue 8 a.m. too, I guess, between 6 and 8. And I guess you can make the case between maybe 3 to 5 is where it's cold, but we'll just call it 4, right? And so using all of these charts together, you could actually make a pretty good case that, you know what, I think the hottest day of the year, probably going to be late July, early August, right? So you're kind of hedging your bet. You're kind of guesstimating, but you're in the ballpark, right? And I'm kind of thinking that, coldest day is maybe going to be, maybe late January. We're probably getting a lot of snow. Could be February this year, right? It changes every year. And also, too, you know the kind of days. So, like, man, I don't want to be outside in, say, July, August around 4, right? It's going to be too hot. And, man, I don't want to be outside around, say, 6 a.m., 8 a.m. in the morning in, say, January, February, et cetera, right? You get the general gist of what we're talking about here, because you're using data and you're using logic to determine, what you think things are going to do. And so this is why we take a look at the news every single day. I call it Uncut because I want to show you guys that, like, we're going through this. I'm not just like making random stuff up, and we're doing this live, which I think has a very different feeling and sort of a mood to this whole thing. Because when this is just real, guys. When you watch TV, you watch YouTube, so many things are cut up. So much stuff is scripted, etc. And what they try to do, they try to create tons and tons of drama. So you're like, oh my God, it's so exciting. Things are going up and down and blah, blah, blah. And that's why, like, a lot of times it feels like people are totally inaccurate, is because they change from day to day to day to day to day, and it's hard to follow. Opposed to, is what I'm trying to show you guys here today to demonstrate. If you use data, you lose logic, you stay rational. You can do really, really fine, right? And not lose your shirt, not lose your head, and it won't feel like it's random at all. So, like, here's an example. It's really interesting. This is Susquehanna. They were actually looking back at the past, and they were saying, okay, we've had 3 days out of 5 where 97% of the S&P has gone up. Are we now going to rally, or is everything going crazy? Is this the beginning of the new bull run? And it's interesting, they're saying like the last time this happened was like in 2000, which is like the dot-com bubble era. And they had this quote here. I just want to read it for you guys. He says, he also noted prior to last week, this week marked the first time since August 25th, 2015, that 97% of the S&P 500 companies were up in 2 of the previous 5 trading days. After that, the S&P 500 rebounded about 13% before making a new low 6 months later. So, this is the kind of stuff where, like, from experience, you say, okay, so, we've seen this before, the same way we've seen, say, the weather is cold in January, the weather is hot in July. We've seen this before. We're like, wow, when like 97% of the market is doing this crazy stuff, it can still go lower. It is a possibility. And one thing that's kind of interesting as well, this is over at Morgan Stanley. You can read the headlines, but basically they're saying, I'll just read it for you guys. A soaring U.S. dollar will force the Fed to pivot away from its interest rate hikes, but that won't be enough to prevent earnings recession, Morgan Stanley says. So this is actually, I think this is Mike Wilson said. He's typically more bearish than other people, and everyone has their own point of views and stuff. It depends which data you're looking at. Some people, they might just look at the TV ratings data. That is a real thing. They're like, hey, we're going to invite you from Goldman Sachs because your ratings, when you go on TV, man, people love to watch that stuff. And some people are like, you know what, I'm just going to look at financial data, right? So it depends. Remember, again, YouTube and TV is entertainment, and oftentimes, and like I said, good investing, solid rational thinking isn't necessarily the most exciting thing, but it does guarantee that you're going to do well, right? And it's interesting because when you talk about this, so basically what we're talking about is the, and it's something I mentioned to you guys several times, is what is the Fed going to do? I think they're going to keep raising interest rates, and that in turn is probably going to affect the earnings of companies. And so one of the things that, if you understand this basic concept in the market, is stocks get their value. Essentially, you're buying ownership of a company. And if you buy ownership in a company that is profitable and their profits are going to keep increasing and their profits are consistent, chances are you're going to do pretty well in the stock market, right? Now, yes, there could be short-term, volatility where things go up and down like crazy, but you're playing for these sort of long-term rational thinking, the same way we talk about how to define coldest day, hottest day, the same way in the stock market. If a company is profitable for years and they're in a growing industry, I think there's a high chance that's a good stock. If a company is unprofitable in a shrinking industry, I think there's a high chance that is a bad stock. Do you see what I'm saying, guys? And it's interesting, too, because talking about what they were saying at Morgan Stanley, this is, I think this is Mike Wilson. Let me read a quote from him. And so this is interesting. So they're saying, according to Wilson, right, this is sort of partisan view, the earnings decline will be driven by several macro risks. So basically he's saying, and I've been telling you guys the same exact thing, I'm just reading the other people's opinions, that the companies aren't going to make as much money going into the future. And this is why. Companies have been forced to navigate in recent months, including China's COVID lockdowns, right? So when China locks down the country, people can't make things over there and people can't buy things over there. I think you guys get that. Surging U.S. dollar, right? So when the dollar is expensive, maybe good for Americans, but it's not so great for American companies making money overseas, because the money that when they sell things to other countries, their currency is not so great, right? Another thing, higher interest rates, right? So that essentially companies that are in debt, their borrowing rates go up. Also, too, if you want to grow a company and borrow money, right, it's more difficult. Also, too, consumers don't necessarily want to buy cars when interest rates are going up. All these kind of things. And then the weakness in Europeans' economy, which you guys know, there's a war going over there. And so it's not like Europeans are gonna go out and buy a ton of iPhones, right? It's not gonna happen. And so then this is what he's saying here. We suspect the uncertainty that these factors foster will lead to both guidance pulls and lowered guidance, both headwinds for forward earnings estimates. So basically what's going on is he's just saying, I just don't see companies making more money in the future, right? And I agree with him. I don't think that's a crazy thing to say, giving all of these things. Also, he says it takes a long time for the next 12 months of EPS, that's earnings per share, to fall for the S&P 500 because it's very high quality, diversified index, and companies are loath to throw in the towel on future quarters until they have to. It appears that more companies are reaching that point where they can't fight it anymore. So what he's saying here, and what we're talking about here, and why I share you guys the news every single day, is that the market as a whole is a collection of 500, they're talking about the S&P 500, 500 great companies, right? And, over time, these companies are going to be good. They're also strong companies. But one of the things you want to look for is like, what is each particular company saying? Because none of us can accurately predict every single one of the 500 companies in the S&P 500. It's really, really tough, right? But the same way looking at the weather, we can kind of get the general sense. And sometimes some companies have more power to sort of predicting the market than others. I'll give you an example. When FedEx came out and said, hey, everyone, our shipping rates are down and stuff like that. And companies aren't ordering so many documents anymore or having so many packages moved around and our employees are asking for more money. And FedEx is saying, and we're closing offices around the world. That gives you a pretty good sign of what's going on in the economy, right? FedEx is slowing down, or Walmart is saying, hey, everyone, we're slowing down. We have a general sense of we're retailers. And so this is why we track the news all the time, because you kind of add these things up together, and some companies will give you a general sense of where that industry is going, and you start to add it all together to your understanding of the full market, the same way we can look at charts determining the weather. We also look at these kind of stuff, right? We want to know, what is the Fed doing? So this is the Fed funds rate. I can see that's 2.56. I think this is probably going to go to, I think they were saying between 4 to 4.5. Why do I think that? Because that's what they say. Literally, that's what they say. And that's why you come out and the FOMC committee, each committee member will come out and say, well, I think the rates should be this. I'm okay with raising it to this. They literally say it in public, and you can track the stuff, so there's not any big surprises. And the market hears these things too. And so oftentimes the way the markets work is they're kind of anticipating where they think interest rates are going to be, what the Fed's going to say, essentially. And then when things change, be it a company reports something different than what they predicted, like say Tesla deliveries were down, or they say the Fed comes out and it becomes raising interest rates way more crazy, than the market reacts to that, right? So the market is always sort of attuned to multiple things that are going on. The other thing too you can do as well, which I've shared this with you guys, is the Buffett indicator. You can watch this. This is showing that we're about 19% above the trend line. So it seems like we're expensive, and this basically measures what is the value of all the companies in the S&P 500 and compares that to the GDP, basically how much is the economy growing, right? So remember, we're talking about when you buy stocks, you're buying ownership in a company, and essentially you're buying the potential of how much money they're going to make in the future. That's the basic gist of stocks. The same way, the easiest way to think about it always is if you're going to buy a house, how much you think you can rent out for, and how long does it take to recoup that money that you originally put in. That's the basic gist of it. And if you don't think you can rent out the house because you don't think there's anyone who has any money to rent your house for that price that you want to rent it for or whatever, you're probably going to make less money, right? And so we track all of these things. Another thing that we like to track on this channel, what is the S&P 500 PE ratio, right? The price of stocks in the market compared to how much companies earn. The mean over history, over time, has been around 16, right? And we're currently trading at 19. So we're still a little bit expensive compared to history. And remember, Mike Wilson was saying it may take 12 months for earnings of companies to come down, because they don't want to come out and say, hey, in public, hey, everyone, we're losing money. Whoa, what's going on? They don't want to say that. They try to hide it as much as they can. And this is why we watch the news, because we get a sense of okay, what's really going on with companies, right? And so I can tell we're trading a bit expensive, but I also can tell we are not at the top, right? You guys can see that we were at the top of probably around there. And then it's definitely come down. And before, when you're up there, right, when you're right there, and I tell people, man, this looks expensive. This looks like an expensive market. Everyone on YouTube and stuff's like, oh, Chris, you're just such a dummy. You're just so dumb. Don't you know this is a different time, man. You got to be buying Dogecoin. You're just an idiot. And this is sort of you have to know where you are in the market. You got to know where you are in your, read your indicators. And this is why, I don't say, oh my God, everything's changing all the time. I don't. I look at the stuff and I can kind of see generally where we are. I've said this for a long time. This is the Shiller PEs. It's a little bit different than the other PE. That this is basically over the last 10 years and takes account inflation. And I've always said maybe if this gets around mid-20s when the market starts to get interesting. At one point this was some crazy numbers in the high 30s. And I remember people telling that because it's how much longer can we go up? And obviously we can't do it forever, right? So this is starting to come down as well. And so if you're interested in stocks, this kind of stuff, at least we're not at the top. I keep telling you that over and over again. I can't tell you exactly where This thing is going like exactly where it's going to go, but think of it like the weather. I can at least have a ballpark idea. The 10-year Treasury rate is 3.62%. The 2-year is 4.1. As long as the 2 years above 4%, it's pretty tough for stocks to be bullish on stocks. Also, too, when the 2 year is above the 10-year, it looks like we're going into recession. That's what that signals. The other thing too, oops, I already showed you the 10-year. The other thing is too is you want to keep track of this. This is the U.S. labor participation rate. This is kind of an interesting one. Okay, so I expect unemployment to go up, and then most likely participation will go down. But we'll see how we're going to keep track of these numbers. So we're kind of at the mean with this one. You can see here the mean is 62%. We're kind of around there as well. But the one that the Fed definitely looks at is unemployment. We've seen different people coming from the committee. These are people who set the interest rates essentially, or the Fed funds borrow rates, better way to say it. But they were saying around 4.5% of where they expect unemployment to go into next year. I'm thinking maybe 5, but who knows, right? I'm a little bit more bearish than they are, or a little bit more bearish than they're willing to admit. That's probably a better way to say it, because no one in public wants to say, hey, everybody, to control inflation, you need to lose your job. No one's going to really say that. It's not really a comfortable thing to say, but anyone who studies this stuff knows that to be true, and they even say that, but they don't come out and publicly make headlines saying that. And so we're sorry about that, guys. So we're at 3.7 right now. I do expect that to go up. So what does this have to do with reading the news? Is so we're tracking all these things. We're looking at company earnings. We're trying to figure out like what are companies saying internally, what are they doing, and eventually you get leaks in this kind of stuff. And this is sort of why when I read the news to you guys, it turns out we're often right on these things, because we kind of know where things are going and where things are heading. So like, for example, I keep saying unemployment needs to go up. We see this right here, the report that came out that job openings fell by 10%. So we're not like, oh my God, I'm so shocked. No, we expected that, and we kind of know generally where we're going. So like, even take a look at this, because this is also news that we've been tracking. I'll read this to you guys. This year, several companies, including Stanley Black & Decker, Corteva, and Goldman Sachs, have started to lay off or leave jobs unfilled to reduce their costs in an uncertain economy. Walmart Inc. said it would hire about 40,000 mostly seasonal workers to serve holiday shoppers, down from 150,000 permanent employees it was looking for a year ago. So that is a major change in hiring for Walmart. They're not looking for that many people this Christmas. So the simple question would be, so do you think holiday sales are going to be good? And if you know, remember I told you guys before, is like, we don't know what every single company in the S&P 500 is going to do. It's hard to tell. But when something like a Walmart saying, man, we're not hiring, they know what their company is doing. They have their own numbers, and that tells me that it's not going to be a great Christmas. And here's the thing. And like, let's say it is a great Christmas, for example, then the market would rally because it's such a huge surprise. But if you watch this data and stuff like that, you're like, okay, I'm not expecting a great, Christmas in retail, right? Also, too, like, for example, Goldman Sachs, they announced that they were firing essentially investment bankers, essentially, right? So if Goldman Sachs is firing people, do you think that is a good sign for, say, investments in the market? Probably not, right? So they're not going to just hire a bunch of people if business is slow. That's not how the world works. And so this is why you track all of these things, and we watch all this stuff together. This is an interesting chart here. This compares the unemployed to how many job openings there are. So essentially, the way it's going to work is when the unemployed people go above, say, the job openings, right? One thing, though, is from my understanding is there's a couple things going on. So the job openings thing isn't necessarily an accurate number. So one is because oftentimes companies will put out fake job listings, meaning that they will still be hiring on the surface, meaning that you'll see job listings online, but they're actually not hiring at all. And the other thing is too, is sometimes many of the job openings aren't necessarily jobs that anybody wants, or jobs that can actually afford to pay the mortgage, pay the rent, right? So this number is a little bit, actually a little bit misleading, because like I said, there may be openings, but maybe not the job you want, or it could be a fake opening. So do keep that in mind. Also too, this is also a bit in the news, and it's kind of funny. This one was the Elon Musk thing, and this is sort of a good example of sort of where things are going versus the day to day. So basically, Musk is like saying in public, we're going to buy Twitter, and then they even sign a contract. We're going to buy Twitter, and then Twitter's like, okay, you can buy us, and then Musk is like, wait, the market's going down. I changed my mind. So from day to day, I don't know what the heck's going on with this thing, but as it turns out, you can't fight the weather, you can't fight the contract that you signed. And his lawyers are probably saying, you know what, Musk, we're going to lose this thing. Go ahead and just buy Twitter and get it done with. And so it looks like they're going to buy Twitter. And it's interesting because when they were announcing this whole Twitter thing, and Musk came in and had like a conference call with all the employees, a bunch of employees started quitting. This is a real thing because they kind of saw the writing on the wall of like, I don't know, I don't want to be a part of this thing. So I started looking for another job. And it's interesting because this is happening in other companies as well. This was just leaked today. That Amazon is actually going to be freezing their hiring. Essentially, I'm not sure if they're firing. I haven't read that yet, and I'd be curious if you guys have any inside info on that. But they're not growing, right? And you take a look at this. We'll read the explanation. It says Amazon is freezing corporate hiring in its retail business for the rest of the year, according to an internal announcement obtained by the New York Times, making the latest tech company to pull back amid the economic uncertainty. Right. So again, we've been predicting this stuff, and this is why this isn't a surprise. It more confirms what we are kind of looking for. The email to recruiters announced that the company was halting hiring for all corporate roles, including tech positions, globally in its Amazon store business, which covers the company's retail operations and accounts for the bulk of Amazon sales. About 20,000 openings were posted in that division as of Monday evening. And remember, too, a lot of these openings might be fake, right? And if you read this here, listen. Candidates with interviews scheduled before October 15th could still receive offers, but they would not start at Amazon until next year. The email recommended that phone calls to screen candidates and other early recruiting activities should be canceled. So that's really funny. So basically, could you imagine that? Like you got an interview from say Amazon, and then like you're all excited, hey, I might got a job, and then the week later they're like, well, we're going to cancel the interview because we decided not to hire anyone. and that is a real thing. You'll get these kind of stuff sometimes. And if you guys have had this experience or having this experience now, please let me know. It happens sometimes where they say they're having an opening, and then you get an email or whatever and say, oh yeah, we changed our mind. No opening. Haha, we're just kidding. And this is sort of like a thing of where companies are trying to save face, essentially. It looks like, though, so remember, Amazon is freezing hiring. It looks like, though, Facebook is actually firing people. We're calling this the quiet layoff here, and this is the headline. Facebook is conducting quiet layoffs by urging managers to label a certain number of workers as underperforming. The moves may lead to thousands of job cuts, and this is sort of why we've been talking about the sort of quiet quitting thing of where you can't just skate through. You're going to get fired at companies these days as we go into recession. So don't follow the trend. Do the best you can all the time and show people that you're a good worker, because you'll get canned in this market. Read this here. Meta, the company formerly known as Facebook, is undergoing quiet layoffs through the shifting performance expectations that could affect as much as 15% of the company's workforce. What? So 15%. And basically, we'll keep reading this here. It told staff last week in a weekly Q&A with CEO Mark Zuckerberg that was extending the hiring freeze that's been in place since May. So they've had a freeze since, May? So we're in October now. It's like, 5-6 months, I guess, they've been not hiring anyone. Just before this meeting, executives told directors across the company that they should select poor directors, but poor workers too as well. But you got to go through your team and say, okay, we got to get rid of 15% of the people. They should select at least 50% of their teams to be labeled as need support in an internal review process. One of the people who spoke with insiders. So basically, what they're going to do is they're going to select people, and then sort of the HR will then determine. And probably what they're doing is they're running numbers. They're looking at people's salary and sort of reviews of stuff like that. And this is sort of what's going to be going on. And like I said, as each company, you look at their forecasts of what they're expecting, and this will help you understand sort of how to think about the market, right? Look at numbers, or where we are. Are we trading expensive or hot? And also to consider, do you think that the future looks good, or do you think the future looks bad, right? That's what we're looking at. And so Facebook's like, yo, I think the future looks bad. Let's can 15% of our workers. That's a lot, actually. Also too, that's changing in the wind happening, which is really interesting, is I think we're going to start to see a changing of the guard over at the big funds. It's already that you're starting to see headlines of Warren Buffett's successor. I don't know when he'll retire exactly. Who knows? But him and Charlie Munger are getting old, and you already see that they have a replacement. The dude's name is Abel. I don't know much about him. It hasn't been announced yet, but I have seen rumblings around of replacement. Ray Dalio is stepping down. Right, there's another popular investor that people like to follow. And also Kathy Wood is starting to slow down as well. So I think she's still over at ARK, but she's sort of like starting to hand the reins off a bit. And it's kind of interesting because I just think this represents sort of, when things are going up and everything's going great, it's fun to be in the market. So, but when things are going down and you got a bunch of rich people calling you, say, "Where's my money? What are you doing with my money?" That kind of stuff, and then it's not so fun. And so, it's funny because people ask like, why didn't I go to finance and stuff like that? It's because I don't want to have to deal with managing rich people's money. I enjoy doing what I do. I was a professor for 10 years. I enjoy hanging out with you guys on YouTube because it's fun to do stuff. And yes, I could totally would have managed, could have managed rich people's money, but the stress that you face in these kind of markets when every single day rich people, and I mean like, people with multi-million dollars are, giving money to your fund and like calling you every day. What are you doing with my money? What's going on with my money? Tell me what you're doing with my money. It's not a stress I want to deal with. And that's why sort of like I've been mentioning you guys in this market, you'll see a lot of the YouTubers be quitting because they got so much stress from scamming people because there was one in particular. There it was this doesn't matter his name, but it was interesting. I learned that they were getting handwritten letters from angry fans of like, you because of you lies and everything, I've lost a bunch of money, etc. And so, just imagine when the stress goes up, the more money that you manage. So just wanted to tell you, like, I think a changing of a guard is happening. You can see it right here. And the other thing too that's really quite interesting with companies, not only are they firing and slowing down, is this was a former marketing person that used to work with Apple was criticizing Apple, and it was interesting because I was kind of thinking the same thing that they were saying that. Apple's not really that exciting anymore. And pretty frank, guys, I have all Apple products. I'm using Apple, all the time. I think it's a great company. But kind of the thing is like I don't have any other choice. There's not that many other choices for computers. You got two. You got Windows. You got Mac. And yes, you could use Linux. I get it. But it's not really a viable option for me. And it depends what you want to do with your computer. And it's funny because we were talking about Apple slowing down. You have the slowdown in growth in China, so I don't think they're buying phones, and you got Europe slowing down. I don't think they're buying phones, and USA as well is like, maybe we'll buy phones, but I don't think so because we're going to recession also, and it could be global. And the other thing is too is that Apple products just aren't exciting. If you read this, it's really kind of funny. His description is this is the former marketing person at Apple is writing, making fun of Apple essentially. Fearful about your elderly parents, get them an Apple Watch and be notified if they fall. Traveling alone in the desert, the new Apple Watch Ultra will let out a piercing scream to help rescuers find if you can't follow the digital breadcrumbs you've set to find your way back to civilization. The implied message is, if you want to live, buy our stuff. Apple now sells devices the way First Alert sells smoke detectors. So the joke that he's making is, before Apple used to be really creative with their marketing and stuff like that, and now it's just like, just buy our stuff because we're just like the Clapper. You guys remember the Clapper? The Clapper. If you guys are too young, and I actually don't know if they run Clapper commercials on TV. Please let me know in the comments if they do. I haven't seen one for a while, but the Clapper was an old device. That the idea was like an old person sitting in their lazy boy. It was clap on it, clap off, and you would clap your hands like that, and your phone, your lights in your house would go on and off. Or the I've fallen and I can't get up commercials. I don't know if those are still on TV. I'm dating myself here, but I'm pushing 50, so it's fine. It's whatever. But those are basically gear marketed to old people, because before we were talking about Apple products being creative and change the world and stuff like, and now their best feature is like they can call someone. It's not that great. And I remember seeing that thing. I was like, this is the best that you guys got. It's not that great. So anyway, hopefully all this stuff is useful, helpful for you. Hope you kind of understand sort of my logic when I go through the markets. I have the indicators I look for. I think about it like I think about the weather and predicting the future, and then I look for news that sort of like either denies or confirms what I think is probably happening. And most of the time when I read the news, it's pretty much confirms what I think is happening. So that's sort of how I look at these things. I can't tell you exactly where the bottom's going to be, but we can put you in the ballpark, and also to sort of guide you to where we think things are going. So thanks again for watching, everyone. Hope this was fun, and I'll see you next time.